Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology, and financial advice. Hosted by Abraham Oksanya, you can expect raw honesty, critical analysis, and energetic interviews. Here is your host, Abraham Oksanya.
Hi there, welcome to Retirementals. I am truly excited about my guest today. Mark Picha is the managing partner of Alta Wealth. Alta, I'm not really sure how you pronounce this, but and Matt is a big user of Timeline and Betterfolio. So I am thrilled to have Matt on the podcast today. Matt, welcome to Retirementals.
Thank you. It's a pleasure to be here. Thank you for having me.
So you are, in my view, one of these rebel advisors that is doing just fascinating stuff with their business within our profession. One that I believe is worthy of emulation. So before we dive into all of that, do you want to give us a little bit of an intro into how you got into the industry and your your journey, the journey that led to the creation of Alta Wealth Management?
Yeah, absolutely. So I fell into the industry, which I think is the common story for most advisors. And I ended up spending 15 years with a big national firm, Towery Law, as it was originally. And we had about 200 advisors. Over the course of those 15 years, I progressed through the firm, ended up as one of the 4 senior partners. And we were an acquirer for a long time, for many of those years, which was great fun, actually, and got to see loads of different firms and looked at different solutions and propositions and software along the way. And then we were acquired at the end of those 15 years, which it turns out is less fun than being the acquirer. So at that time, I took the opportunity, took my cash, and went off, had a bit of time off, and then set up Altor with a clean sheet of paper. So yeah, it's a fairly standard story, I'm afraid, but an enjoyable one along the way. And the last 5 years running Altor have been fantastic. Very different experience to working in a big national firm.
Interesting stuff. So I'm interested to unpack some of your views on, on the consolidation side of things. But before we get into that, so tell us about Alta today, about the firm, the clients, give us some metrics, give us a sense of where the business is today.
Yeah, so Altor, so 5 years in, we're a team of 7. So we've got 3 advisors at the moment. We've got 1 trainee advisor. She actually is doing her CII apprenticeship, advisor apprenticeship. So she'll come to the end of that in the spring next year. So we'll be 4 advisors. We've probably got capacity to take on a 5th. So we're actively looking at the moment. In terms of clients, so we're about 110 core clients. We advise 50 children of clients. We might come on and talk about that a bit later on in terms of how the proposition runs. So we're looking after about 2/3, 1/3 sort of core clients and their family, so they're younger family members. We're responsible for about 320 million of assets these days. So you can work the numbers in terms of the type of client we tend to work with. Broadly, our range is sort of 750,000 to, the upper end 13 million, and our average client would have about 2.5 million in our core service. That would be. So it's fairly standard in many ways. I mean, we don't have a niche as a firm as such. People are always talking about niches. I always sort of feel like we should have one, but we haven't got one. I don't know if it counts. I mean, there's one big FTSE 50 company that we work with, and we look after all of their senior executives. So exco down to senior management level. I guess that's a niche. Depends how far you stretch that term.
So this is fascinating. Then, so average, 2.5 million in AUM. 100 families, 100 million per advisor, and if you I don't know if I want to do this. 2.5 advisors because you got one of the advisors training. Pretty pretty strong numbers there. What do you credit for this in terms of the size of clients? I was listening to a podcast the other day, and one of these very, very regarded industry consultant in the US, and he said that one single thing that some of the best performers as advisors do, or fastest growing advisors, however you want to frame it, one of the key distinct thing about them is that the average asset per client that they deal with is pretty high, and I will put yours in the top 10 percentile, if not even 5 or 10. So in terms of IFA, so what do you credit for this? Did you just go after these clients? Tell us the secret, if there is.
Yeah, so I think it's probably a couple of things, to be honest. The 3 advisors that we have at the moment are all very experienced, 15, 20, 30-year experience in the profession. I think that's relevant because over time working for a bigger firm with a big name, with access to some very wealthy clients, ones that have built up with us actually over the years. That's part of the success, absolutely. For the clients that have joined us more recently, actually, we have a lot of clients that find us. We keep our marketing very low key. Our website's quite hard to find deliberately because we're not a volume business by any stretch of the imagination. Wow. And extraordinarily, but prospects still find us in quite reasonable numbers for us as a firm, which is why we're having to take on new advisors to service those clients. And we've got a different model, so we work on a flat fee basis, and I think that is very attractive to clients with larger portfolios. And we've had several prospects that have actually sought us out deliberately because they've Googled, flat fee advice, or I don't want to pay a percentage. I don't know what they're putting into to Google to get us, but they're ending up with us because they're looking for a different model for how they receive their advice. And so I think that probably does make us very attractive to that sort of client. Because we're flat fee, it does mean that we probably have a narrower band of people that we could work with anyway. So we are too expensive for a lot of mainstream clients, and therefore that means that we don't take those clients on. It gives us time to go out and find the clients that are in the space that's appropriate for us. We would refer those prospects on to other flat fee advisors who are used to dealing with smaller clients, simpler affairs.
So flat fee, then let's unpack that. How do you structure that proposition? Is it, does everyone just pay the same, the same flat fee? And what led you down that path?
Yeah, so it's a really good question. I mean, setting up your own firm after 15 years of having advised means you can genuinely start with a blank piece of paper and you can say, well, what are the good things that I want to replicate, and actually what are the bad things from a client's point of view that I don't want to replicate or want to avoid. So taking that approach meant that we looked at every part of the business and the proposition when we were setting up to say, what do we think is the best thing for a client? And on how we got paid, we just felt that offering the same service to every client and charging the same amount for that service was the way to go. We have broken it into 2 service levels. So we just have 2 within the range of clients that we look after. One, which is our core proposition, where we will provide pretty much everything advice-wise. So obviously constant ongoing cash flow planning and investments, including more esoteric investments, tax-led, etc., and plenty of tax planning. And then a simpler service, which is priced at a lower price point, where for clients that don't need that additional tax planning, tax-led investments, and that complexity. So it's the 2. So everyone within our clients are paying one or other of the fees that we offer. The only difference we have service-wise is where we have clients who want their adult children to access advice, but the adult children can't necessarily afford it, then our clients can pay a third fee effectively for us to advise their adult children. Hence why we've got, a third of our clients are actually adult children who ordinarily probably wouldn't come to us as clients without that family connection.
And I have heard all these arguments against flat fee, the fact that you're taking risk, by the fees doesn't directly correspond with the risk. You could do something with a £2 million portfolio, and you get it wrong in terms of taxation, and that. Does any of these things crop up in your conversation with clients in how you decide the fee? What's your view on that?
No, so I'll be honest. Look, most of my good friends are IFAs. That's how sad I am, and most of them operate on a percentage basis. So look, each do their own. But for me, I can't see the link between the work we do and the value of a client's portfolio. I can't see how that's fair for me personally. If I do hear that risk argument. I hear that a lot. That gets thrown back at me a lot. But it's almost as if we're operating in an environment where there isn't professional insurance for what we do as advisors. Look, there are bigger risks inevitably. If you get it wrong on a £10 million portfolio compared with a £1 million portfolio, yes, there are bigger risks. It's going to be a bigger number if you get it wrong. But I guess there's 2 points about that. A, we're all insured, hopefully without large excesses. So you don't really have that. You certainly don't have 10 times the risk between those two clients. And B, why are we? That's a massively negative foot to start out on with a client, to say, well, look, you've done well. You've built up 10 times the wealth of this other client. I'm going to charge you 10 times as much because there's a chance I'm going to get this wrong. It's a really odd starting point, whereas surely we should be saying, well, look, what work do you need me to do? And to be perfectly honest with you, Abraham, some of the smaller clients, some of the clients with the £1 million portfolio will have much more complex needs. Maybe they're mid-career, maybe they've got all sorts of tax planning, constantly changing careers every couple of years. You've got to deal with employee benefits, protection. There's just a whole wealth of things going on for those clients. Whereas potentially, actually, for the £10 million client who's retired, maybe there's a lot less work to do actually for that kind of client, and therefore, really, it's about the work that needs to be done. So I'm afraid I don't buy the risk argument. I mean, I wouldn't. It's not what we do. It's not how we get paid. But I do think the percentage fees it's a historic anomaly, really. We control the money. We've always done it that way, and it's sort of the path of least resistance. All the research suggests that clients don't or very rarely convert mentally percentage fees into a pounds and pence number. Right. And, for us, the conversations we're having every time we're interacting with a client, it's always about the work we've done and justifying fees, because the fees are very obvious. I know we've all got fee disclosure these days, so every client should know it. But I bet if you went through most clients and asked them, what are you paying for a percentage-based advisor, they wouldn't be able to tell you in pounds and pence, however good the fee disclosure is. So, yeah, so I'm afraid I have a bit of an issue with it. Now, hear me in that. I spent 15 years being a percentage-based advisor, so I am not squeaky clean on this at all. So my history would suggest otherwise, but we believe it's the right thing to do now. We get really good feedback from clients about it, although they do find it painful because we're always talking in pound costs rather than percentages.
That's really helpful. Thank you. And I like the humility that you approach this is heartwarming. Right. So then let's go over to investment proposition, right? So tell us how you approach the investment proposition. You mentioned earlier on that you have esoteric investments, to use your word, for some of the clients. How do you approach this? Is there a centralized investment proposition or central, service, and then other things added depending on clients' need?
So I maintain there's a couple of people that argue with me, but I maintain that we don't have a centralized investment proposition.
Right.
So there are days where I wish we did, frankly, because it would be a lot easier for us as the advisor. But I'm not a big one for making the advisor's job easier if it means not doing the right thing for the client. I know it sounds a bit holier than thou, but a lot of clients come to us and they have their own views, they have their own desires as to what they want to do. And look, if those views are really wacky, then we will tell a client, and we're very happy to debate with a client if we think they're going off on some mad scheme. But a lot of the clients we deal with are actually from financial services, but just different bits of financial services. Although we do have some advisors that we advise actually, and so we're very happy to work with a client to build a portfolio, a completely bespoke portfolio for them with their input. We've got those clients on one extreme. On the other extreme, we've got clients who just say, look, you guys know what you're doing. Recommend the best thing for me. And so we have a broad range of investment solutions, but if you looked at sort of that usual bell curve distribution, the guys in the middle, they're going to be largely on a platform. They're going to have some low-cost access to global markets in the most efficient way we can buy it for them. That might be a model portfolio service. It might be a multi-asset fund, dare I say, a Vanguard Life strategy. But a lot of them will have some kind of MPS service around that. Depending on their preferences. So there might be some active MPS model portfolio service. There might be ethical if that's their particular desire, or social impact investing. But that's more of a satellite approach. So we would tend to have satellite themes around a core passive approach that's buying market returns. Well, what I will say, I mean, on the fixed fee side, when we set up 5 years ago, we would ask every single investment manager, will you offer us a flat fee option? And most of them said, well, no, that's crazy. Why would we do that? We make more money on a percentage. Why would we ever do it? And we kept saying to them, again, with our example of 1 million and 10 million, you don't have to ever know the client. You're just going to give us a fund template that will be applied on a platform. Why would our client at 1 million pay you 0.2% a year and at 10 million pay you 0.2? You are doing... You've no additional risk in their case. I mean, it's even more crazy, in my opinion, than advisors operating on a percentage basis. It's absolutely nuts. And 5 years ago, there were a few that we found, and we were happy once we'd done the due diligence, and even some bespoke managers that would operate on a flat fee basis, but not many. But there are more and more, and that's really encouraging for me. 5 years down the line, there are many more than we started with 5 years ago. Obviously, Beastfolio being one of those, which is really exciting for us, because actually for our clients, our typical client, the more that can be paid for on a flat fee, the more efficient their portfolio is going to be, the better their net returns, so the better a job we're doing for the client.
And, before our call, I was looking at the pace at which you're onboarding assets to Beastfolio, and I was thinking to myself, gosh, I better get in touch with Matt to see what's going on here, because the pace is very strong in our view. So thank you for that. I guess the question I wanted to ask then is, so you're dealing with very wealthy clients. The core of the portfolio proposition is low cost capital market. Yes, you would have maybe, I assume, some sort of EIS type products if that's needed for the client. But do you get pushback from clients on this? Like, I've had all sorts of arguments, low cost is too low cost. It's too simple. Or do you get pushback from clients on these things or no?
Yeah, we do. We do from clients. I mean, if you look at the marketing budgets in financial services, the
Right.
big spend is the big active managers. Those are the big billboards at Waterloo Station. Whilst
Right.
everyone's waiting to board their trains. I mean, they're not in the same numbers anymore, but they certainly did do. And so clients do absorb that. We're humans. We're susceptible to marketing. If we weren't, then companies wouldn't spend so much on it. And so that kind of message is in a lot of our clients' minds, at the back of the mind. What if I could do better? What if I could beat the market? Or what if I could invest with someone that can beat the market? And look, the active managers we use are at best, I would say, level pegging with markets and with their passive equivalents. We don't have any that are tracking below at the moment. But we all know, all of those of us that are in the know that all the academic literature says that actually you can't outperform markets. And it amazes me that firms continue to pretend otherwise, actually, on the advice side, less so on the fund manager side, because that's, they'd be destroying their own business model if they did. But we recently took on a client of a well-respected mid-sized firm, big breadth and depth of bench of professionals on their investment side.
Right.
And you look through the portfolio, and it's all the funds that are top performing, have been top performing in their sector, all first quartile, all 5-star rated, but it's all backwards looking. So all their clients are getting is everything that's done well in the last 3 years.
Yeah.
Now we know, because the research tells us, that those funds are the most likely to mean revert and underperform over the next 3 years. But they're relying on being able to cycle out before that becomes apparent to the clients, and just constantly cycling into the next best thing. But you're always cycling from, what hasn't performed very well because it was, you didn't catch it in time. You didn't catch it before it performed.
You're selling
into
low,
the next thing, which isn't good. Yeah, exactly. You're just constantly turning over the portfolio. So it leads to a really interesting conversation actually with clients, and there is a place for active management. If clients have particular themes that they want to pursue, then very often active is the way to go for that. But it would tend to be driven by a client's preferences if we were to build those on a satellite positions.
Now, a word from our sponsor. Nikki Heaton-Jones is the Managing Director and the Chief Investment Officer at Betafolio, the high-tech, low-cost, discretionary model portfolio manager. There are many flat-fee, retainer-based model portfolio services out there. Why is Betafolio pioneering this approach?
I think we're more than a flat fee model portfolio service. We're a true investment partner. We're offering a full investment service to advisors and taking it to a deeper level. We don't just want to push a button and send an investment template. We're building technology and processes so that we can support advisors at the individual client level with client portfolios on real practical issues like cash management and decumulation and lots of other areas that are associated with actually implementing a financial plan rather than just providing a model portfolio. So that's where I see us as being pioneering and perhaps taking the MPS product to a new level.
Thank you very much, Nikki. So let's talk about technology. I know you're a big technology user and a rebel technology user, because I was talking to you a while back and I said, well, what's your CRM? And then you went, well, we built our own. So I'm interested in start with what your tech stack looks like today, and tell us a little bit of a story of what you've done with this CRM. I don't want to use the term back office, but off you go.
Yeah, so I mean, if we're the rebel, I guess the evil empire would have been the CRM and back office and client portal software that we were using before. So we did look. When you get started, when you're building a firm, you work with what's available at the time. So you go with all the leading tech and you build out the tech stack from there, right? So we adopted one of the major players in the CRM market. And within a very short space of time, we were hitting up against problems. It was built on pretty old technology. It was ugly. It was hard to work with. It was just a constant daily frustration. And we looked around. I mean, I'd done a lot of work for my previous firm around CRMs and around cash flow planning software. And we had all sorts of firms come in and present, and we looked at lots of different solutions. And in the end, we just felt that actually we were going to be going really frying pan to fire on the CRM client portal side. We couldn't find anything where we could sufficiently bespoke it for our clients that we were happy that it was going to be something that we were going to be proud of ultimately. So we thought, well, let's build our own. How hard can that be, right? Starting software from scratch with a small team. With a day job to do at the same time. So we had a bit of a misstep initially. We picked the wrong software provider. They produced something that went into beta testing with a few select clients, and we picked our select clients who were IT security professionals. And unfortunately, they picked our first version absolutely apart. So we had to. That was cash burn. That was cash burn. We had to just walk away from that. But the current provider we're with is really good. They've built something for us which, release one was as good as the software we were paying huge amounts for previously. And then every release that we keep pushing out, we keep upgrading and upgrading that to the point now where it's light years ahead of what we did have, and we've still got loads and loads of plans for it. It's not cheap, but actually, to be honest, with what we were paying to our previous big supplier, it's no more expensive than that. So it's something we're very happy with. It's a light touch CRM. It provides our clients with a client portal. We very much built it from the client side. So we built all the client functionality first, so they can go in, do secure messaging, share documents with us. They can fill in a fact find online. All of their asset values are pulled through on a daily basis and presented back to them in what we think is a nice format. They can run performance numbers, or they will be able to soon once we've cracked some of these poor APIs you get from some of the platforms. They'll be able to run their own performance numbers. But importantly, we also wanted the financial planning to be front and center of that portal as well. So we built a section in there where we can replay their cash flow results to them. So we're really happy with the outcome. As you all know, obviously, always with software, you embark on something and then other people come into the market with other propositions. Not thinking of anyone in particular, and start developing functionality. Timeline functionality. Some of that is getting to the point now where we're looking at it and going, oh, okay, well that looks better than what we're doing. So maybe where's the trade-off here? Do we drop some of what we're doing and so that we're not duplicating essentially? So, I mean, the wonderful thing about being in software is nothing stands still except the dinosaurs who are going to get wiped out. And look, it's not just CRMs in financial services. There's data analytics software, there's cash flow software that have captured large market share, and they're the incumbents and they're profitable, and they're entirely relying on not having to develop their proposition.
They're evil empires. Yeah.
Exactly. They are all the evil empire. They're just multiple ones. And that business model relies on advisors not ever bothering to change software provider.
Right.
And it's a huge upheaval to change software provider. And some of these guys make it really difficult to leave. We had to pay our old CRM provider. We had to pay them to extract our own data, our own client data. Yeah, we had to pay them for them to give us our data back, which is extraordinary as a business model goes. But the danger for all those firms is that if they don't develop and they don't improve and innovate, someone else will come along and eat their lunch. So it's an exciting time. I don't know how you feel, but in fintech at the moment, it feels like quite an exciting time. Lots of people trying different things. I don't think all of it's going to work, to be honest, but there's lots of people trying, and that's great. That's a great ecosystem for advisors, actually, at the moment.
Yeah, absolutely. I couldn't agree anymore with your assessment of, where advisor tech has been. We have all these, in my view, legacy systems that were built literally 20 years ago, 25 years ago. They weren't built for the current world that we live in. And the entire business model is predicated on making it incredibly difficult for advisors, to move. And in the early days of Timeline, we spent a lot of time wanting, we didn't set out Timeline to, replace or even compete, frankly, with any tool, right? Timeline was originally meant to just be, a decumulation engine. And we spent, best part of a year, over a year actually, trying to integrate to all these other tools, because advisors were telling us, well, I like Timeline, but it doesn't talk to my, to my cash flow or other things that I did. So we said, okay, fine, we'll take on that challenge and we go integrate with them. And this is just completely, it's a mess. Many of them don't have APIs. The ones that have APIs really, it's not very good, right? So we went 100% sort of in a different direction, and we said, sod it, we're going to do this. We're now going to evolve Timeline to a point where we replace 3, 4, 5 different pieces of technology. So we introduced the fact find, the cash flow, the portfolio analytics on Betafolio. And I am really excited about where we take this. And I'm really excited about the stuff that you've done, because that back office, your CRM client portal is certainly an area that we haven't touched. We don't have a short-term, plan to, but I'm really, really interested in how what you do evolve, or what you've done evolve. I see a couple of firms who are taking, the way I like it to put it, taking their own sort of future in their own hands. You guys are one. Our friends over at Rockwealth, I'm sure you know these guys.
Yep, yeah, I know those guys well.
There are others, and I know that I forget his name now. The chap at Code Potato,
Gareth Thompson.
Gareth is building something in that space. So keen to support and to help in any way that we can. All right, we'll see how that evolves. So let's bring this back home. One of the big questions that I really wanted to get your opinion on is, this is in 2 dimensions, this big trend towards consolidation, right? Every time I pitch VCs, which I've done quite a lot in recent days, everyone says to me, all these people say to me, aren't, small independent firms being acquired by, or being sucked into, large consolidators, like the one you've come out of, Towery, SJP, all that stuff. So, I want to get your views on this, right? Do you, I guess you must see a future in small independent firms, running their own business, taking control of their own destiny, if you like, versus these big consolidators that are gobbling everything up. Where do you see this, this trend going?
Yeah, so I've been on both sides of this, and when I was involved in buying up firms, in being the consolidator, our experience very often was that you'd pay a lot of money for firms, and you would gain the advisors and the clients as a result. You'd try to mold their proposition into yours, or you try and change their proposition into your proposition.
Right.
And most times what would happen would be the best, most entrepreneurial, most new business focused advisors would walk away.
Right.
Something new. Normally after they've taken their payout or their cash or whatever the deal was.
Yes.
And what you'd keep is the more average advisors and the more average to the smaller clients. And the problem with the big consolidators is actually, which I don't think is well known, particularly from the firms that invest in them, is what you end up with is this ever-growing tail of unprofitable clients. So I know the finances of some of those big consolidators, and some of them have got horrible-looking finances where no one ever takes away from them the small client. They lose teams of advisors, but those teams of advisors never come back and take away the small client. And these firms have had to ramp up their charges and ramp up their charges. I mean, in some cases, taking 3% a year in sort of total vertically integrated costs from these clients. And they're still losing money. And if you look at the breakdown of their clients by volume, they've now got more clients in that loss-making space than they have in their core client space. And frankly, the only way that they're keeping those clients on board is by cross-subsidizing them with their bigger clients, charging their bigger clients where there are big profit margins to be had on a percentage basis. And that's cross-subsidizing that smaller client base. And that's a real issue, because actually what you're doing, consolidators very, very often are averaging down the quality of their book all the time. Because you lose your top guys take the top most profitable clients. You're constantly averaging down the quality of the client base that you're looking after. And then it becomes a numbers game, right? So then you cut service levels because you can't afford to service those clients profitably. So that was my own experience. I mean, my experience doesn't go industry wide. I'm sure there's some consolidators out there who say they were doing a brilliant job. But actually what you then get is you get some really good guys who have set up businesses, small to medium sized businesses, typically strong team. Often they'll take a team of people with them. You had a really focused proposition, fairly narrow client profile. And those are the guys, frankly, that are out there doing the innovative stuff, either on the investment side or the planning side or the tech side, whatever it is. And we, to a degree, I would consider us to be one of those. But I know of several that have teams of people that have come out of the big firms. They've built some really great propositions, very client-centric, very client-focused, very compliant, doing the right thing, and really high-quality advice and high-quality advisors. And I think that's, all the story is about consolidation, and that is clearly the trend if you look at the numbers. But I think actually if you look at what's sort of quietly dropping out in the sort of exhaust of some of those big consolidation exercises, there's some really good firms. And I don't think ultimately the small IFA firm is going to die off. We're still in the majority, I believe, last time I looked at the number. So there's still a huge part of the market that's in that space, and that's a huge market to serve if you can get it right. And there's some very passionate people there. I mean, some people who are passionate about some things that I wouldn't necessarily agree with them on, but they tend to be very committed, very passionate about what they're doing. You don't see that kind of passion typically when you're talking to people who are working for the big firms.
Absolutely, it's incredible, and I think that when I was talking to all these sort of VCs outside of our industry, I wish I had the explanation that you just gave, and the way I ultimately got around this, obviously getting with your help, is to say, well, yes, you can see the trend of consolidation is easier to see. The more important trend that you don't see is the breakaway. right? The Breakaways, the Mats or the Alters of this world, the Rockwells of this world, all these guys who are running incredibly successful firms, who are breaking away from, these large empires and running their own show. And, so I said, go speak to some of them, right? And let's compare notes. Hence why you had a few of them knock on your doors. The other corollary to this is to say, well, how do you compete, right? How do you compete with big brand name firms who have lots of professionals and experts, frankly, for every different part of advice? How do you compete? And you've done this very well, even for larger clients, right? Because the idea is, or the general assumption is that clients with larger portfolios will go work with big firms, because if I'm as I am, if I've got 5 million liquid portfolio and I go to Outer Wealth down the road and they've got, 50 million in assets, I'm going to be 10% of their asset. Whereas if I go to, SJP or whatever tower, how do you compete with these large firms for large clients, let's say?
Yeah, so it's a really good question, although the one thing that is missing in that is what clients we are used to dealing with compared with what some of these big firms are used to dealing with. So we've just won a client who is, quite a way above our average, but we've won him from a much bigger firm than our firm, 5-6 times the assets under management. But in reality, as an individual, he was the biggest client of the particular advisor he was dealing with.
Right.
So
right.
Because we're used to the advice needs of a client of their size, then we are talking their language very often. We're talking about the sort of problems they're worrying about, the sort of advice they need. We've got the experience of the slightly more complex tax planning that you sometimes require when you're dealing with large multi-million pound estates. And these firms can be big, but they can be big with thousands and thousands of mid-sized clients. I still find it extraordinary, some of these big firms. You look at their average client. We sometimes get these industry publications through, don't we, that shows total assets under management, total number of advisors, total clients. And some of these big firms, you look at the average client they're dealing with, and it must be really simple day-to-day work, 9 to 5, because these clients, surely, it must be a couple of ISAs and maybe a pension. And there's not a lot to do, is there, Abraham, to be honest? There's not a lot to do. And these are volume businesses. Look, we would not be able to compete with those big companies on volume. Right. That's why we don't market, because we don't need to, but there's no way we could ever compete with them from a marketing perspective. But we're not a volume business, so we don't need to. We have a cap on the number of clients that each advisor looks after, which is, again, why we're having to bring new talent through. And that's so that we're giving a brilliant service to these clients. But we bring something that you'd have to go to the very top of the advisor bases in these big firms to get to. And getting to those guys is pretty impossible for most clients.
Incredible stuff. So as we begin to wrap this up, I guess my question for you is, where do you take this? 350 million in AUM, 3 advisors, pretty solid figures and practice and business. You look to me like you're in your 20s, maybe 30s.
Oh, you liar! You liar! Yeah, it's a really good question. Look, we my partners. So we're structured as a partnership. We're not structured for sale. We don't intend to sell ourselves. The debate amongst the 3 partners is, well, why are we not bringing the shutters down? Why are we still open to new business? We're a bit different as a firm. So when we set up, we said, look, let's be ballsy when it comes to what what we do to give back. So we said from the outset that we were going to give 10% of our gross revenue. So 10% of the first lot of income that comes in goes straight out to our sister foundation. And frankly, that's the only reason why we're growing. So, our revenue's about $1 million now, so we're pushing sort of 125,000 a year out to our sister foundation, the Outdoor Foundation, and that's more motivational on a day-to-day basis for myself and the partners to be. And there's a lot of fun to be had actually in running a small foundation and being able to give grants to various good causes. So that's the reason why we're growing it still, because we can have a real impact. At the end of the day, we love our clients to bits, but ultimately, when I hear other advisors saying, it's the good we do, we need to be a little bit careful and a little bit more humble about what we do. We're dealing with the wealthiest percentage of the population in the country. We are engaged in tax planning. We're trying to grow portfolios. We are not social enterprises. We need to be honest. We need to be honest about what it is we do for a living, really. And look, so for us personally, and this is not, I'm not judging anyone here, but for us personally, we need to be giving back. Ultimately, our plan is that we are developing sort of the next generation of advisors. We're not poaching. We're trying to grow talent from within the business. And our hope, sincerely, is that they will replace us as partners, at the point at which our advising faculty start to fail, which hopefully might be 10 or 15 years off. But we're hoping genuinely they'll come up through, they'll buy into partnership, we'll exit partnership, as you would expect with any other professional firm. Yeah, absolutely. Yeah. So this is what the lawyers do. It's what the accountants do. This is how a partnership works. And the amount of advice businesses that are being built for sale, again, I'm personal friends with a lot of these guys, but the conversation on the side of the football pitch is not about what they're doing for the clients. It's about how many more years until they can sell themselves to someone else, and what their target sale price is. And we're not about that. Look, that's part of my, it's going to have to be part of my retirement planning, getting slowly bought out of partnership. But that's how the other professions operate. I don't know why we're so obsessed with growing and selling in this business.
Fascinating stuff, which is a really good segue into how does a managing partner of a wealth management firm, financial planning firm, plans, his own family's retirement. Give us an insight into, pitch our family retirement plan.
So it's very vanilla. I don't know if that's a good thing or a bad thing, but I guess so. One of the frustrations as a tax planner is very often by the time we're dealing with a husband and wife, whichever way round it is, there's very often a disparity in the assets one or other has got, particularly pensions. Yeah. And as a tax planner, I find that incredibly frustrating because it means I can't maximize the income tax allowances, and and once you get to that stage, you can't unwind it once you've built up more of a pension. So myself and my wife, we have a pension each. We've stopped contributing to mine, so we're contributing to hers to try and get her up to parity. Yeah. I think we can get there. Actually, I think we've got long enough. I think we can get there. So it's standard couple of SIPs. She made me set up an ISA. What they say about cobbler's children going unshod. Us advisors generally pretty bad at looking after our own affairs. So she runs the finances. My son, whilst I was in the middle of my MiFID II 10% notifications that I was having to send out in January last year because markets were falling and we were having to constantly email and phone every client to tell them their portfolio was down by 10% because the regulator thought that was a brilliant idea. He had the bright idea that he'd invest his ISA in Vanguard ESG All World Developed fund. So he's done the best out of all of us in the family because he got his timing right. He's the market timer out of the family. So it's the standard things we'd recommend to all clients. So Bram, to be honest, it's the standard tax planning. As a family, because I'm deeply conscious that I don't want my teenagers developing into 20-somethings that are going to end up hating their dad for his investment choices, we are entirely invested in the minimum ESG screened, but social impact investing with EQ investors in London actually is the biggest part of our overall portfolio. So there's the biggest weightings to social impact in there.
Interesting.
And then of course it's the staff coming up and buying us out. Hopefully at some point that'll hopefully add a bit.
Good stuff. Matt Picha, thank you for your time. Thank you for your wisdom and for the good work you do. Thank you.
It's a pleasure, and thank you, Abraham, for all the work you're doing in financial services as well. It is gratefully received by those of us who are desperate for some tech that works. So thank you.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together, led by my producer, Hannah Dickinson. Thank you very much, guys. I'd like to thank our sponsors, Timeline app, the retirement planning software, and Batefolio, the high-tech, low-cost flat fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.